Hi, good evening, everyone. Good morning, good afternoon, wherever you are. Welcome to our webinar for today with the theme Building Automated Credit Decision Engines for Digital Lenders. Um, we're going to make this as interactive as possible. We'll take questions towards the end of the session. You can feel free to drop your questions in the chat. Without wasting time, we'll just get right into it. For today, we'll be covering the Nigerian credit landscape. We'll get to know why automation is actually urgent. Then we'll go through the anatomy of an automated credit decision engine. We'll also, talk through the core components of a credit decision engine, as well as building the AI decision engine itself. We also go through the fraud detection layers, the integration, compliance, as well as going live with your decision engine. Then we'll take questions and answers. This should take about 60 minutes. So let's get right into it. Yeah, pretty much a bit of background about me. I'm a founder, product manager, a credit tech expert, and a decision scientist. And I've worked with quite a number of leading financial institutions in Nigeria, as well as I've worked with, providers that work on decision engines and, fraud tools. I also have a personal company, Jupiter, that is an AI-powered credit decision platform that enables lenders to, automate loan origination, underwriting, disbursement, as well as risk analysis. Um, We'd also be having Emeka Oswagu to join us as a guest speaker, and he's a global engineering manager. He leads a distributed team delivering compliant platforms across multiple regions. He's actually currently the engineering manager at Carbon Tech Limited, and he leads a team building digital banking and fintech products. He has also lived the credit decisioning solutions. So we'll be getting his expertise and input on during the course of this webinar. Again, please feel free to leave a chat and drop your comments, and we would attend to it as soon as possible. So getting right into it, the Nigerian credit landscape. Um, the data has it that we're currently approximately over 240 million in population in Nigeria, and only 45 million is actually banked. So we have more than 190 million that are underbanked. And out of this population, less than 10% has formal access to credit. Um, okay, let me just check in. Please feel free to leave a chat if you have questions, and also confirm in the chat that you can hear me clearly, right? Um, Moving on. In the digital lending space alone, as at 2023, the total disbursement value is around 2.8 trillion naira. And for this disbursement in this digital lending category, they have about 30 to 40 default rate, which is as a result of poorly modeled books. So, what are the key challenges currently that the Nigerian digital lenders are facing? The first is um, there's thin credit files. That means most borrowers have no formal credit history. We've had cases where you look up on a customer and you're getting no each report. We're unable to, get. Most lenders are unable to get the credit history of the customers that are coming to apply for these loans. And there's also an over reliance on manual decisioning, which is also slow and consistent. If you joined the last webinar we did, we talked about how manual decisioning is actually based on guts and traditional data. Um, we also have informal income streams that don't fit the traditional scoring models. The current models that majority of the lenders have, it is either you are a salary earner or you have a business SME, which is actually done via your monthly revenue. But we also have, some group of people that actually leverage on cash for their transactions. We also have some that it is not defined that they are business owners or salary earners. A typical example is Uber drivers. We have a couple of people that fall into this category. Um, so yeah, we also have, Nigeria, we have fraud is at scale. We have cases of identity theft. We have synthetic IDs, and we have agent manipulations. That's as a result of those lenders that still leverage on sales agents. So we've done this before. Um, we What is actually the difference between manual versus automated credit decisioning? I mean, the first is the turnaround time. For some, it goes between 2 to 5 days. Those that have thin files that they don't have a lot of transactions that they have to work on, they have a turnaround time of maybe around 24 hours, but it is actually slow. There's also inconsistent analyst judgment. Like I mentioned, most analysts, a quite number of them, give their verdict based on guts, based on assumptions, and based on some certain feedback. And we also have, for loans that are manually reviewed, the fraud detection is actually not real time. It's based off when the reviewer is checking the documents and seeing that, oh, there are anomalies here and there. And it actually scales poorly. The manual decision bit. And as the volume increases, the cost actually rises because, for example, if they are moving from disbursing 1,000 loans per day to around 10, per month, to around 10,000 loans per month, right? They would feel they need to get more reviewers, and the scaling is actually very slow, and the decisions are usually undocumented, and it is hard to audit, right? These are some of the flaws with the manual credit decisioning. But moving to automated engines, you can get decisions instantly in less than 60 seconds. And every decision, because it is driven by logic and algorithms, they are actually consistent and they are rule based logic. And in terms of the fraud detection, they are real time because in the algorithms in these engines, there are fraud signals that have been embedded. And the behavior checks are also instant with algorithm to identify trends and patterns rather than having an underwriter reviewing those trends. There are flags, signals that these automated engines come with, and the cost is linear and it can scale exponentially. Maybe the only thing that you need to reason about is the cost of storage. And yeah, for the automated engines, because they are system driven, the audit trail is actually very efficient. And whenever the regulatory agents, want data, you're able to go to your DB and pull out this information. So now moving on into the anatomy of an automated credit decision engine. First of all, what is a credit decision engine? It is an automated system that evaluates, approves, declines, and manages loans using data, rules, and models for consistent risk and operational control. If you're able to take in the points in this definition, we have evaluate. After evaluating, this is what a typical reviewer would do. Those that still go with the manual process. When a loan file comes in, you need to assess whether the person is credit worthy. And how do you do that? You evaluate the user. Again, please, in the chat, please confirm that I'm audible, and yeah, and drop your questions should you have any. All right, cool. So moving on, like I was saying, for the manual review, for you to make a decision, you need to evaluate the credit worthiness of, you know, the applicant, and this is based off having to check here and there, based off what your credit policy says. And after doing the evaluation, you're able to come up into a conclusion, and that conclusion is a decision. It is either the loan is approved, the loan is declined. And there's also the third one, which is managing the loans. The loan appraiser actually does not stop at the point of disbursement. What happens after disbursement? How do you manage those loans? And from the manual standpoint, this is still done using data. Like, off the top of my head, the underwriter have to check what is the income of the customer. He or she needs to check somewhere, be it the bank statement, be it the pay slip. There's actually a source of data that the underwriter would use. Um, okay, cool. Thanks, Jessica. Yeah, there are a lot of data points that the underwriter would use to, you know, arrive at a decision. So data is actually important. After confirming the data, they need to apply rules based off their policy. It could be a location rules. Some lenders can say, oh, we don't want to disburse to anybody from the northern region. The the applicant has a good credit history, has a good financial statement, but is in the location that is actually um, not acceptable in the credit policy. So rules are actually embedded in terms of decision making and models. We'll get into models, and we'll also have another session that, you know, talks about how credit modeling is actually done. And I could also recommend a few courses on Udemy for those of you that will be interested in understanding how models, credit models work. Um, yes, modeling is actually a, a system or a structure that is used to determine the probability of default of a customer based off existing data, right? Yeah. So moving on to the features of a credit decision engine. The first is risk scoring. That's to quantify the borrower's credit risk, right? What is an engine without a scoring? So the number one feature of a decision engine is it has to accommodate risk scoring. Um, I'm sure quite a number of you would have seen something like credit score and all of that. So these are part of the risk scoring that a loan engine or a decision engine should be able to handle. And an engine should be able to make decision. I mean, why are you a decision engine if you can make decision? You can approve, decline, or even set limits based off rules that have been integrated. And an engine should also be able to, you know, determine the pricing, that's the interest rate and the tenor of the loan, right? We have quite a number of digital lenders that cap a particular risk level to, say, a particular tenor and a particular amount. Say, for example, if you have a high risk level because they don't want to cut you off, they test you and, you know, check on your repayment habits. Um, you can start with the least amount that they can offer, say 10,000. Then, depending on how well you pay, you tend to progress. So the engine should be able to handle the pricing based off the risk level of the customer or what the policy says. And yet the loan engine should be able to instantly determine or detect, you know, fraud or any suspicious activity based off the data that is being fed into the loan engine. And also, after disbursement, a loan engine should be able to get a feedback from whatever system the lenders are using to understand how those loans that were appraised are performing post disbursement. And the last one, end-to-end automation of loan life cycle with analytics. A loan engine should be able to tell you um, how long it took the applicant to be able to. I mean, there are different stages, there are different types of loan engine. There are some that are more sophisticated depending on how you want it to be. But again, all the data that the loan engine needs are usually from a payload, and it, you know, make reference inference from the data that is being fed. So the loan engine should be able, like I was saying, should be able to automate the loan life cycle from application to disbursement to repayment, and even in the event of default. So these are the information that the loan agent should be able to handle and make improvement and suggestion for. Now the process involved in getting a functional credit decision engine. The first is data ingestion. Um, this is just a process where you give the loan engine all the information to make decision. From the application standpoint or from the applicant standpoint. The same way on the manual part, before you can appraise a loan, you need to get a file, right? And aside getting a file, you also need to go to third-party platforms to get additional information that is not provided in that loan file. Um, I think my internet is a little bit unstable, but please confirm I'm still audible. Um, okay. Moving on, Nigeria and its internet issues. So yeah, the data ingestion, like I said, is getting information, getting data from various sources, from the applicant, from third party bureaus, um, from the bank statement, and also alternative or alternate data. And that is one edge that the automated credit loan engine has over the manual bit. For a lender that is into the business of, automated loans, you should be able to leverage on technology to be able to access the customer aside, the information that the customer has provided or what other vendors has about that customer. What can you as a lender also get from the customer? And that is where the alternative data comes in terms of the device metadata, and this can comprise of what is the loan, the battery of the device when the customer is applying for a loan. What kind of device is it? Is it jailbroken? Is the device an emulator? There are a lot of data points that you can get from the customer's device, because the loan is being originated by, via the customer's mobile. Um, yeah. So the next is, after getting all this information from the customer and it is being sent into the loan engine as a request, and you're expecting a response. Before the response comes, the applicant has to be scored. So there are different layers. So the next is credit scoring. The credit scoring is not just based off the credit history. There are different policies, and a lot can be embedded for scoring a customer, right? You can leverage on the repayment history, and we'll get into the details of how the credit scoring actually works, and quite a number of variables to give the customer a score. And that score can now be used to define a threshold that, hey, customers that have above X score, they are going to be declined, or customer that has above X score are are going to be accepted automatically. A customer that falls between a particular score range are going to be reviewed manually. So after that is being done, these are best practices of how a loan engine is structured. Then the next is the rules, and this is where the credit policy of the lender comes in. I mean, what does your credit policy say? Like the first I mentioned earlier is about the um okay, thanks, Buki. The next is the location. There could be policies around location. There could be policies around the age of the customer. There could be policies around the income of the customers. There could be policies around a particular pattern in the customer's financial statement. Maybe the customer gambles a lot and all of that. And there could be policies around round tripping. More like the customer is trying um, to game the system by round tripping ensuring that they are inflowing the account, and for every inflow there's an outflow. So that is where the credit policy comes in. If you notice, these are the things that the underwriter would also do. But imagine all of those processes that that underwriter would be doing within minutes, hours, or even days. It is being done in less than 60 seconds. So we also have blacklists. Most lenders have customers on their blacklist. So when they see that applicant on the loan side, automatically it is declined. And they also have caps. And that's the one I mentioned earlier concerning the credit scoring. What thresholds determines what cap or what customer type. Is the customer coming for the first time? Is the customer coming for the second loan? Is the customer coming for the third, fourth, and so on? So the loyalty of the customer is actually used to cap the loan for some lenders. And yeah, the AI decision layer. When we talk about AI, I mean, it's not as complex as it sounds, but it is artificial intelligence. Like what you would do, it is actually done by a robot or by a system. So it's more like what a human can do. A system is just automating it. So that same decision that the underwriter will do based off the policy, gods, and whatever, based off all the data that has been ingested, the score and the rules, the system is able to make decision without human intervention, right? Whether it's going to approve it, decline it, review, or assign limits. And yeah, disbursements, and loan monitoring. That's where the feedback loop comes in. After the disbursement, how is the loan performing? Is the customer defaulting on the first payment? Is the customer having missed payments? And so on. So as far as the Nigerian space is concerned, for you to be able to create a robust or at least a standard loan engine that would make your books look good, you have to integrate with a few partners. The first, which is one of the most important, is the credit bureaus. In Nigeria, I'm sure a couple of us are practitioners. We have three. I can also leverage on the fourth. Um, we also have BVN and NIN validation. In recent times, there's actually need to get information about the customer's BVN. It is not just to curb identity fraud, but that information about the customer's BVN can actually give you insights. So let me give you something for free. The recency of the BVN registration is actually an important key in credit decisioning. So you might want to leverage on when was the BVN registered, where was the BVN registered, what institution was the BVN registered, and also same for the NIN. So, you need to sync with these third parties to be able to come up with a robust system. And also the bank statement analysis API. Bank statements are in two types. One can be institutional driven, that's the customer's transaction within your system, and the next is the customer's transaction with other banks. That is one that require you have to download your bank statement. You have to link your bank statement anyhow you want to do it, whether you are doing mono, you're doing MBS. That's external statements. So statement analysis is actually important because it gives you insight into the customer's income, spending pattern, and behavior of the customer. Right. Another important thing that in 2026, most smart digital lenders are doing is the telco and the alternative data providers. You need to also check recency is actually very important. There's a trend in the industry now where a customer takes a loan and defaults on the first payment, or even try to game the system up until a particular time and is no longer reachable because the phone number that was registered is actually not accessible. And by the time you check, for some cases, that same phone number is what is on the customer's BVN or even NIN. So um, these information are actually orchestrated for the purpose of gaming your system and also defrauding the organization. So again, there's a common saying: risk cannot be eliminated, but can only be mitigated. So if you have rules around, the telco information, and for you to get that information, you have to leverage on third parties that provide insight into this telco data. And we've mentioned alternative data. How do you get information about the customer's device? You might not have that technical capacity, but we also have third-party providers that with their SDKs, you're able to, get information from your customer's device and you're able to use it. And one of the most important one is the social profile. The phone number is the phone number registered on WhatsApp. Um, it's the phone number registered on WhatsApp. Um, when was the phone number registered? How many online accounts is the phone number linked to? Not just the phone number, also the email address. Is the email previously on blacklist? Is it tied to Netflix, Amazon? I mean, all these services that Nigerians typically would use. I mean, Netflix, YouTube. I mean, the email address not being linked to any social profile is actually a flag that you know you can leverage on in your rule layer. So these are the key integration points as far as the Nigerian lending space is concerned. Now, moving on to the core components of the data sources. I mean the credit decision engine. Like I mentioned in the previous slide, the identity and the bureau information is actually important. That speaks to BVN, the NIN verification, the customer's credit reports. I mean, CBN has mandated that you check whether the person is on watch list or PEP screening. So this is also important, and all of what is information is retrievable via API. You don't have to log into a portal to check with a unique ID. You're able to get this information. I mean, it is automation, right? Excuse me. So this flows, I mean, from BVN to credit bureau to PAP screening to liveliness check, all this can be done within seconds, right? And we also have the financial behavior of the customer to access the capacity of the user, right? So this can also be ingested into the credit decision engine. Like from bank statement analysis, you can get hundreds of trends and patterns that can be used to improve your decisioning. Um, for some lenders that have access to payroll of the customers, all of all these information are also retrievable via API. And for some, it's just about working smart. For some that they usually get this via maybe spreadsheet, this can also be uploaded to their DB and retrieved via API. And within seconds, you're able to get all the information you need from the financials of the customer. And yeah, alternate data is cannot be looked at on. We have mobile money history, we have telco data, we have device signals, which Emeka will touch on, and we also have the social footprint, and also the application data. What did the customer give to you? The employment information, the loan purpose, the device type, because you're able to get it from the applicant, and also the location of the customer. And by the time the model is trained or the loan decision is trained in a way that it's able to pick signals, imagine you are getting hundreds of requests from the same phone, you are getting hundreds of requests from the same location, I mean, at the same time, or you are getting loan application at a particular time of the day, usually midnight, that people are sleeping. Um, all this can be used to you know um, to create a robust decision engine. The next is the credit scorecard. It's one of the most important part of a decision engine. Like I said, a decision that cannot score, I don't know what the name would be. So, I mean, these are just dummy weightings for different variables that many lenders, I mean, is a given that they use these data points. It can be expanded to up to as long as you want it. But, I mean, before you give an applicant funds, before you disburse to an applicant, you should be able to know how well the customer has performed with other loans that they have accessed. So the repayment history is actually very important, and it is required that they are scored. The income, I mean, you can't give a customer 1 million without verifying that they can actually handle that 1 million. So the income and the cash flow would give insight as to that variable. I mean, the credit score of that customer too is actually very important. The loan to income ratio, I mean, everybody calls it debt to income ratio. For the income that you have verified in your data and the current loans that the customer has, I mean, what percentage of it as the customer utilize? It is also one of the important variables that you can use while building your decision engine, and also behavioral signals. Um, and this actually tells to how well, I mean, it still points to almost all of the previous data points, but it's just flagging based off a signal point of view. A customer can have um, performing loans without history of default, but again, the recency of that report, the first time that the customer accessed the loan, what date was it, how far is it from the current date, those loans, how on time did they pay, are they paying for a 12-month loan, why are they liquidating within 2 3 months? I mean, this might not be an issue for a few lenders, but I mean, these are signals that are always overlooked and can be insightful if you pay closer attention to it. Please confirm you can still hear me, guys, and leave a comment so I can confirm that we are here together. Um, yeah, so for my side, everything looks frozen. So, um, all right. So moving on, um, if you check to the right of my screen, you can see their score bands. I mean, these are just dummy data. It's saying that when a customer score is actually from 750 to 850, automatic approval. If it is between 650 to 749, approve and review. 550 to 649, approve and reduce. I mean, these are subjective and based off the risk appetite of the customers, but this is what um, an automated credit decision engine is able to undo. Um, yeah, moving on to the third component, which is the rule engine. A decision engine, like I mentioned, if you check the flow, one part is actually the rule part of it. There are hard rules, there are soft rules, and there are rules that are loyalty rules, more like to reward the performance of the customer. All these things, the loan agent is able to have access to all this. The first, I mean, these are sample rules. For hard rule, imagine the BVN of a customer is blacklisted. Do you want to learn to search? Before the underwriter is looking at this list and all of that with a sync with the API, the loan agent is able to determine that, oh, this customer is in blacklist is yes and all of that. The customer has a non-performing loan. The customer has a non-performing loan. The loan agent is able to detect that because it is just a data point in the payload. The age is outside the policy. It is a data point. It's able to flag it immediately. Is on watch list. Um, it has open bankruptcy and whatever. The loan engine has access to these data points and is able to flag this hard rules and decline. And soft rules could be DTI based, whether the customer is a first time borrower, the income is irregular, there's no credit report, there are records of delinquent loans on the customer's credit report. So you might not want to go hard on these guys. So the same way an underwriter will say, okay, let us give concession. The loan engine can also be configured to give concession to this kind of customers just using logic. And the loyalty parts, I think that's clear. So Before I go to this, I would just give room for um, our guest speaker. I think is here now to um, talk us through his part. Um, Hi, Emeka. How you doing? You're muted. Um, you're still muted, Emeka. Okay. From my hand, your audio, I can't hear you. So, I mean, guys, can you confirm that you can hear Emeka in the chat? Um, um, I'm not sure if that is. Just give me. Let me see if it's from my hand, but I really can't hear you, Emeka. Sorry, guys. So while we wait on Emeka to join, Emeka, any point if you can just pick, we'll just take it up from there. But your mic is not muted, but I still can't hear you. So I'd like to also confirm from the chat if Emeka is audible. Okay, thanks. Fair. Um, Yeah, I think we just have to we'll get back to Emeka's part. I hope he should be able to sort his mic issues. So Emeka, if you can hear me, whenever you're ready, just um, talk over my voice. Um, okay. All right. So Emeka, can you confirm from this Google Meet? Can you hear me? You can just leave a chat if you can hear me from the Google Meet itself, not the live broadcast. Oh, Maker left. So we'll wait on him to join. So okay, I think Emeka is back on. Now, Emeka, can you hear me now? Oh, I think can you try disconnecting maybe the device, the mic device you're using, and just use your system mic or something because I'm not even seeing any movement from your hand. All right, sorry about that, guys. Yeah. So building the AI decision engine from static scorecards to ML powered decisioning. We're going to have a separate webinar on, like I mentioned, how credit is being modeled. But for context, the main purpose of modeling is to get the PD of the customer, the probability of default based off the data that you have, right? And there are different types of model. Some can be done as simple as an Excel or any spreadsheet, and while some you have to use tools like Python or R, right? So, I mean, the one that is mostly common is logistic regression. Emeka, I see your back. You can speak if I can hear you. I'll confirm that. So we also have the gradient boosting, and we have the neural network. This is usually for large data sets, and we also have the champion challenger framework that combines a couple of models and selects the best out of the models. Again, all of all these models are to get the PD of the customer. So imagine um, based off the data that you have, there are different behaviors depending on the kind of model you're doing. For LGD, for
All right.
example. All right, yeah, Emeka, I can hear you now.
Great. Thank you.
All right, thanks for joining. I'll just hand over to you so you can take your part. While when you're done, I'll just proceed from there. Good to have you, Emeka.
Okay. Thank you, William. Can you please confirm you can see my screen?
Yeah, I can.
Okay. Thank you, everyone. Sorry for the brief delay connecting my mic. I'm here now, so we can get started. All right. So today I'm going to be talking about fraud detection layer when it comes to a decision engine. So before I get started, a quick introduction about myself. My name is Emeka Oswago. I'm an engineering manager and a financial platform startup founder. What that basically means is that part of my day-to-day job is to ensure that, from an engineering point of view, we are meeting organization KPIs and stakeholder expectations. So today's topic is about fraud detection from an credit engine point of view. So if we think about the credit engine, like William has been talking about, these are basically set of rules, custom rules, if you will, when it comes to how you want to approach credit from an organizational standpoint, right? So if we look at that as the brain, then the fraud and security part should be seen as the immune system, right? And basically, what this means is that how do we then build a stronger immune system or a security system, if you will, that protects
Sorry to
our
cut you.
decision engine?
Sorry, Emeka. I would like to. I'm getting a comment that someone
Okay.
can't hear you, so I'll just. Can we confirm now that Emeka is audible because it's clear from my hand? And please, in the chat, let us know if you can hear Emeka now. Okay, I think they can hear you, but there's a comment on your background that it's echoing, but I think that is still manageable.
Okay.
Yeah.
Let me see if I'm able to fix that also. I get the echo. Okay. All right. All right. So going back to the immune system, please, if you have difficulty hearing me or anything with my audio, please let me know. I've resumed sharing my screen now. So going back to looking at the security part, which is the fraud detection layer as the immune system, we need to then understand how do we, if we have a decision engine, how do we optimize for growth and speed? This is part of the things that William has been talking about. And, how do we answer the question of who is credit worthy when it comes to customer selection for credit? And then when we make that decision, how do we now focus on maximizing our approval rates, while we lower our risk tolerance? Then we can now pair that with the fraud layer. How do we optimize security? How do we optimize resilience? How do we defend the decision engine to ensure that it is not being exploited. And some of the primary questions that you would care to ask as a business owner would be, who's trying to deceive us? Are we focusing on blocking adversary actors and people who are trying to cause harm to come and explore our decision engine to get either higher loans or to scale through the policies that we've set forth? Okay, so let's look at architectural pattern and where we place them in order to have an effective decision engine, right? And we have two options. The first one is pre-decision gatekeeper. This can be seen as an asynchronous option where we have all our rules engine and we are checking on a case by case basis. We check fraud execution before the engine, is invoked or run. We block fraudulent application early. Part of the pros on this is that we save on compute time because we are running everything ahead of time. We are able to make those decisions before the request or application is submitted to our engine, and then we are able to determine whether or not we want to go forward with that particular customer. Disadvantage of this is the latency, right? While a customer is trying to get a quick loan, for some of us who has have products like quick loan, quick credit, or now loan and stuff like that, we know that the nature of these loans are always fast from application to disbursement, right? This process, if not handled properly, can introduce delay in the process and can affect, turn down time from an application point of view. Because if your customers are keep waiting for, long time for you to make those decisions, they can then walk away from not, taking your loan. Let's look at option two. Option two is a co-pilot asynchronous option. This is where, while the credit decision is doing its thing, deciding if your customer is credit worthy, in parallel, we are also doing a fraud check on all of the services that we care to use. So, for example, we either querying the BVN, we're querying some of the other third-party services that William has spoke about. The advantage of this is that we minimize latency because we're sort of like doing two things at the same time, right? We're able to have a system that is faster from a decision point of view where we can decide whether the customer is credit worthy, and then we can look at the risk from a data point of view of whether or not we need to give this customer or approve the customer for loan. So what are the disadvantage and risk of approval flag, scenario requiring reversals? There are cases where based on either stale data, data mismatch, the decision engine can either make wrong decisions. So let's look at the recommended approach. And the recommended approach is a situation where we have both the synchronous and asynchronous process, where we basically do pre-decisioning, high sensitive fraud signals. This is where we are using semantic identity, device reputation. We are doing that ahead of time when it comes to a customer getting a particular credit. So by the time you are coming as a customer to the system and you want to apply for credit, you already know some certain things about it. You already know based on your device metadata, your network activity, your IP, whether or not you meet a particular threshold. And then we can then combine that data with the decision engine to make a final decision. Moving forward, let's talk about the fraud detection pipeline. So what the fraud detection pipeline basically are the stages that we move the customer, his data, or entity that represents the data from one stage to another when it comes to our credit decision process. So stage one is, how do we get identity information about the user? This can be IP, how frequently you use the applications, what is your connection speed, what are your device metrics, how do we collect all that information and segment it and then save it in the first stage. right? Then stage two is keep deep and complex feature computation, right? This is where we then use all those metrics information that we've collected about the customer. For example, how often do you use your app? What is your device strength? What is your device make? Um, what is the device network latency on your phone? How often do you make requests and all those kind of things? Then we build a query graph analysis and network analysis about you. We then build a behavioral pattern also on how you use your devices. We also reach out to, we can support this process with third-party devices like services like William talk about, where we can go to the BVN, we can go to the WhatsApp data, we can go to the mobile phone data to see how many services you're connected to, and then we can use that to build a full picture of what are the metrics from a user point of view. So the goal of this is that we're able to have extensive signal on a particular customer. And this is important down the line when we have the decision, because some of the criteria we have can be as simple as if a customer is always logging in and the customer is always logging, let's say, on an Android mobile phone. But because you want to apply for an high-end loan, you now start logging in on a iPhone 17 or something like that. Because we have this data and we have the frequency of use, we're able to determine whether or not this is being fraudulent. And why this is important is because at the point of lending, customer behavior tend to shift. It's not usually static. You see people trying to fake things. You see people trying to make up data to back up their request so that they are able to scale through the decision process. Okay, moving on to the next phase, which is the fallback strategy, right? Building a pipeline is great, but like every system is always subject to downtime, failover, or unavailability. The question then is that how do we build a fallback strategy that helps us to retain information about what we've gathered so far, right? So if we have a downstream service that fails, we need to have a predefined fallback logic. Basically, a predefined fallback logic can be a set of rules that are coded or semi-coded that changes, maybe on a weekly basis, on a monthly basis, or based on the risk appetite of the organization to now say this is going to be a backup for us in case XYZ is not in place and our pipeline is unable to produce the results that we want effectively. Okay, so moving on to what I consider to be the crucial part of building a fraud detection layer. It's all about memory. And in the industry, the approach that we take, that I see most organizations take, is they use a stateless approach. So what is a stateless approach? A stateless approach basically is when a customer comes to you, they want to apply for a particular loan, and at the point of applying for that loan is when you are trying to determine who they are, what they are, what is their credit history, and whether or not they are credit worthy or not. The approach we're supposed to take is a real-time stateful approach. So let's talk about some of the problems here before I move to the next phase. Some of the problem that we face here is if you have a single transaction from a customer, that's okay. The customer can perform one transaction, it's legitimate, that's okay. But if you have 10 transactions from a customer, you are able to pull out more information. Now think about having 500 transactions from a customer. You are able to build a substantial graph information and analytical information about customer device usage and service usage for you to be able to determine whether or not they are trying to defraud you or lie to you at the point of application, right? The next phase is the three crucial criteria for having a stateful memory. The first one is velocity counter, number of application per device, email rolling time, windows, how long are the customers making applications? If you try to make application multiple times? How do we store that information from an IP-based point of view? How do we keep track of it in the next, application that we see from a particular user? What about the alert threshold window? What are the thresholds that are being set for us to be able to verify you as a customer from application to reapplication and even disbursement and maybe even the payment? What are the thresholds that we've set for us to be able to determine, the customer velocity in this particular key metrics? So sessionization, basically sessionization is having a particular long-term memory of user behavioral patterns, right? User behavior across single sessions. When you log in to the mobile application, so in the case of customers or institutions who give out loans through mobile application device or web application device, how do we track the user sessions? What are the things you do when you log into your mobile application? As soon as you log into your mobile application, are you, doing X, Y, Z? How do we determine what those things is, and how does that factor into our decision in the future? Typing speed, tab switching, copying and paste, and stuff like that. Funny enough, this information is also very crucial because there are some people that will come to you and tell you basically they need loan for a legitimate reason, and they know that your organization is willing to give loan for that particular reason, and they lie to you about, I need loan for either, education or business or something like that. Meanwhile, they are looking for loans to go and, have a party or stuff like that. If you are able to track their sessions, what they copy and paste, you are able to then determine for yourself to say, I have enough information to be able to determine whether the use case for this credit is in line with our business decision. Entity resolution. How do we then map, all of these data points into a single entity? Like I said, the most important thing here is what we know about the customer. The more we know, the better for us, right? That's why we need to have a stateful approach. We're able to then collect all these user metrics, all this data information, then map it into a single place where we can then attribute it to a particular customer, and then we can feed that and use that in our decision making process. So the last part for the memory portion is, the solution, high speed, stateful storage. What kind of storage do we need to consider for us to be able to make this a viable solution? So there are multiple ways we can always think about storage. As we know from an high level point of view, we have different type of database. We have NoSQL database, we have in-memory database, we have database, graph database, we have different type of database. They all have different use cases for us. And the way we choose to store, or rather what we store and how we store it and where we store it, plays a big part in how we are able to use it. So for example, part of the things that we need to consider, especially when we are thinking about real-time memory for lending, is how do we use a database solution that allows us store information fast and query information fast, right? And one of the consideration we can have here is Redis. Redis is an in-memory data solution that allows you store information fast and read information fast. The reason for this is because it is living particularly on the memory. It is not being read into disk, so the I/O speed or the input and output is relatively fast compared to a traditional database. We also have other advanced streaming process where as soon as we are collecting this user metrics information, we are passing it into solutions like Kafka, and we are basically having like a data pipeline where we can then, transform and apply business logic and then eventually store those information in our data warehouse for long-term storage. This will then be essentially the brain of the decision engine when it comes to understanding which customer is looking at for a particular given session. So let's talk about the decision layer, how we combine signal for intelligence. So looking at this diagram, we have the rules, machine learning model, the anomaly, and then the enabler orchestration. Basically, what this is talking about is, before I dive into that, I would like to, talk a bit about how it is being done now, previously, as opposed to 2026. The way it's being done previously is we usually have, and a lot of businesses still run this process, where we have a monolithic rule engine, where you have everything in one particular place. Um, your decision lives in one particular solution. The disadvantage with this is that it is hard to maintain, right? It is easy for attackers to reverse engineers to understand how you give loans, what you are checking for, what are the cutoff mark, what are the criteria. It's easy for fraudsters to probe with different type of applications to see, okay, if I apply for let's say 10 million naira and I say I'm a master degree holder, will I be approved? If I apply with BVN and I, deposit 1 million in my account and I request for 10 million, will I be approved and stuff like that? So fraudsters are always going to try to probe your system. And having a monolithic rule engine makes it easy for you, for a business to fail in that regard because all your decisioning is isolated in one particular place, from the rules to the models to the anomaly check. It's going to be very easy to probe and find loopholes within the system. So, what does a better approach look like? A better approach looks like having separation of concern, where we have different approach from rule of speed and availability, supervised model, unsupervised model, enabler orchestration, having them separate. Again, the advantage of this is they are separate services. Each services are fundamentally responsible for different things. They can work in parallel, they can work simultaneously depending on business requirements. They can be used to check individual parts of the customer application without exposing key insight or behavioral processes or internal process to other services. That way, it's very, very difficult for an attacker to exploit your decision engine from just one application or various types of um, application. Okay. Another advantage of this is that it allows us, conduct A/B testing. It allows us probe weaknesses. We can also determine a static system in predicted system in a predictable system. So what this is basically is, if we have um, separation of concern from a system point of view, we can look at this system individually and then decide what parts needs critical attention from a business point of view and how do we need to address them. So let's take, for example, we need to change our rules because of a CBM policy or whatever policy we are considering. We can literally just test only the rules, do A/B testing of different type of criteria with different type of customer sample size, and then the model and the anomaly detection will still work the way it is. Likewise, we can go to our machine learning model and say we need to be able to achieve XYZ speed based on business requirements, and then our rule engine is solid and tight, and then we don't need to touch that, and we focus on this. Again, some of the advantage of this is that we can do incremental rollout. So what do I mean by incremental rollout? If we have a particular new product as lenders, where let's take for example, we started with we have an organization who is starting with nano loans, and we know that nano loans has different type of risk involved to it. And let's say you are going to educational loans or car loans or stuff like that, you want to be able to upgrade the particular model, and most importantly you want to be able to test with a different specific sample size. Let's say you want to test with salary earners alone, or you created a particular type of loan that is meant for students in our institution, and you want to be able to test specifically for them. You're able to roll out this type of deployment where your rule engine will work the same way it works for 99% of your customers. But when it comes to the particular user segment that you care about, you are able to then do the canary deployment where you slowly incrementally test with these customers, and then you can roll out your change at scale. And most importantly also, you can definitely roll back, because while you are testing something, you are not satisfied with the results. The beauty of this defensive deployment is you are able to roll back for whatever reason, from a business point of view. Okay, so I think I talked about the A/B testing. Randomized testing. You can have randomized testing across a particular geographic location. You can have shadow mode where you can either upgrade the system to log different type of data that you want from a customer, because one of the key advantage of this is you have to have retentive memory, right? If a customer is applying for loan and your system is denying them for based on any reason, you need to be able to know that reason over time, and need to make sure that you are progressively watching to ensure that your concern from application 5 you know has been addressed in application 10, and then there are no room for fraud and whatnot. Okay, so this is where I'll take questions from the audience. If you guys have any questions, I'd like to take questions. If not, this is the end of my topic. Thanks for listening. William, over to you.
Oh yeah, thanks, Emeka.
Hello, William.
Yeah, we'll take the questions after Emeka. Thank you. All right. It's good to have you, Emeka, and that was quite insightful. Um, I mean, a couple of terms that you used might
So,
not.
are there any questions I can answer now?
Um,
I'm done with my slides.
okay, just let me check questions from the chats. Then just give. Do we have questions for Emeka? You can drop it in the chat. Um, um, okay, so we just move on. So like I was saying, um, the terms Emeka was using might sound, you know, big to some people on the call. However, our last webinar was we were talking about how to, you know, stay relevant in the credit risk space. Be more of a credit tech person. So you might want to go back to the previous session that we have, and you can also connect with me or Emeka on LinkedIn, so we can walk you through how you can, have a full understanding of, credit from a technical point of view. Thanks again, Emeka, for taking time to join us this evening. Um, yeah. So again, guys, please confirm you can hear me. I mean, the network keeps, making me sound muffled, and internet is pretty much not stable here. We'll wrap up in the next 5 to 10 minutes because of time. Yeah, please confirm you can hear me, guys. All right. So yeah, we're talking about building AI engines. Emeka had talked about the four detection layers. I mean, for you to be able to come up with something that automates a system that disburses high value transaction. I mean, it has to be as sophisticated as possible, and that's why we need these fraud detection layers in place. Um, so I was talking about model, which is one of the first pillar of using AI for decision engine, and the model is basically to get the PD, that's the probability of default of the customer, and the the one that most lenders use. We have the logistic regression, we have the XG boost, which is the gradient boosting, we have the neural networks and the champion challenger, and we'll hold another session for each of these models so that you understand how it works. For some, I mean, basically the first, you can do it from spreadsheet, while for others you have to have an understanding of programming language like Python or how itself. Um, so for that model to be very effective, you have to train it with historical loans, basically more of bad loans, and you also label the defaults. For some of this model, bad loans are labeled as one and good are labeled as zero, right? And also need to embed feature engineering in these models. You train, you validate, and you test, because the most important feature as far as credit model is concerned is being able to test that model and train the model so that you can have a better predictive strength. Yeah, in terms of some metrics that are used to measure the effectiveness of your model, we have the Gini coefficient and we have the care statistics. This might sound big, but in subsequent webinars, we're going to break down how this impacts the PD of a model or a customer as far as credit is concerned. And it's also important that these models are being monitored to check the impact of these models, and also to you know do some sort of monthly refresh of the model. And also the case of human, as far as AI everywhere, the case of human intervention cannot be overlooked. So human has to be in the loop for you know to ensure that your model is actually doing what it is supposed to do. Yeah, so, I mean, Omega has talked about a few fraud detection layers from a technical standpoint. Um, but from a general standpoint, I mean, Nigeria ranks the highest in terms of fraud. And don't quote me, but this is from a source. So we have identity fraud that is trending. We have fake BVN. We have stolen BVNs. I mean, stolen BVN. BVN can actually be stolen, and they are actually fake BVNs too. We have BVN moves account. We have address fabrication. These are based off trends where you can see almost everybody applying for a loan applying from the same address. I mean, your loan agent should be able to identify these trends and pattern and flag for manual review. And we have synthetic frauds, in the case of fabricated credit profiles. Multiple have same device, referral ring manipulation. I mean, I wish I was able to dwell into this fraud cases, but we would have subsequent session, and this point will be noted and we will discuss before we go into the subject proper. And there are also, like Emeka has mentioned, about the typing speed, the copy and paste field detection, the offer application search, and the velocity, right? And we also have device intelligence, that's the device ID fingerprinting. We have some devices that are rooted or emulators. We have VPN, because some use this to bypass whatever rules you have. If you say you don't want to give loans to people outside southwest, southeast, south, you don't want to lend to the north. Imagine somebody in the north having to use a VPN to change location to somewhere in Lagos, right? These layers, these tools are able to identify whether it is a VPN that is being used, right? Quickly moving on. So the end-to-end automated loan origination flow, from the customer application to verifying the identity that the owner of whatever data that is submitted, BVN, NIN, is actually who is applying, because liveness check would have been done, device would have been done, device check would also have been done, and you're also pulling data from different sources to arrive at a risk score, and also layer it with your rules, and a decision is being made whether to approve, decline, or review manually, and you send offer to the customer. Yeah, that is the end-to-end flow of an automated loan origination flow. This is what an underwriter will do within hours, days, right? But within a split of seconds, I mean, you can arrive at a decision for a particular application. um yeah, I think for now just keep this. Um Yeah. So I believe so far you've been able to understand that data is very important as far as building credit decision engine is. The data has to be structured, data has to be correct, right? And there are different data source for you to be able to come up with a robust loan engine that is very effective, from bank statement, from bureaus, from alternative data, and also rules are also very important. And when layered with model, you have a great loan decision engine. So scorecards, using models that we just mentioned. Um, I mean, fraud prevention is also a non-negotiable. When you are, building the system, you are building it with the mindset that people are going to, game the system. So you are building the system like you are a guard, like a security guard, try to mitigate as many exposures as possible. And compliance is also very important. A lot of startup, a lot of lenders have been fined because they are not compliant. I mean, the lending system is being regulated by CBN. We have FCCPC, we have the NDPA. I mean, quite a number of them. So whatever engine you're building, you have to ensure that it is compliant with the regulation. And monitoring is also very important. The engine should support feedback loop, but you should be able to um, get information based off loans that were approved. And a trend can also be, we have approved loans, why are those loans not disbursed? These are the information that your loan unit should be able to holistically give you insights on. So yeah, thanks guys for staying with us up till this time. We really appreciate, and I hope that you've been able to learn quite a few, and you can connect with us on LinkedIn, and also reach out via WhatsApp, Gmail. You can also leave a comment here if you have questions. Yeah, so at this point we'll be taking questions. Do we have questions from the chat? Um, yeah, it's time for questions, either for myself or for a maker. So we open to taking questions right now. All right, guys. That sends one message that it is really self-explanatory, and yeah, for those that still want to transition into tech, credit tech, again, feel free to reach out, and we would be able to, you know, recommend courses that can guide you in the path that you're willing to pursue, and also offer mentorship to you know the early birds. So yeah, once again, thanks for your time. It's great to be here. Thanks for joining. Have a wonderful evening. Bye, guys.